Hello, fellow Rebel Capitals. Hope you're well. So, big news of the day, retail sales really took a hit. We're going to go over that. And keep in mind that retail sales are in nominal terms. So, when you adjust for inflation, it is a heck of a lot worse. Also, the New York Fed's manufacturing survey comes out today and plummets to a level that we haven't seen since 2023, which of course begs the question, is the economy starting to roll over? Are we seeing the cracks in the dam, so to speak, get bigger and bigger and bigger to the point where even the mainstream media has to acknowledge it? The narrative changes, and then the stock market continues to go down. There are no certainties, only probabilities, but I think these are the questions we need to be asking as prudent investors. And then also, I want to touch on this insanity from the New York Times. In this article, they had the audacity to publish this Sunday. You're definitely going to want to stay tuned for that. So first and foremost, let's get over to retail sales out today. Here we go from the U.S. Census Bureau. And you kind of get the feeling, too, that the floodgates are opened as far as the economic data. And what I mean by that is they're holding back, or let's say spinning the data, manipulating the data when Biden was in office. And now all of a sudden it seems like, okay, we can tell the truth. The floodgates are open. Here's what's really happening when we open up the kimono. Maybe that's happening. Maybe it's not. Food for thought, right? So when we look at the U.S. Census Bureau, and this was released today, advanced monthly sales for retail and food services. Now, first and foremost, look at the trend. Can I zoom in on that? Let's try to zoom in. Yeah. So going back to December, you see that they are all positive numbers, although, like I pointed out at the top of the video, and what I was saying back then, or highlighting, is this is not adjusted for inflation. So especially when you look at the January numbers, which, by the way, were revised down today to a negative 1.2%. More on that in a moment. And then we see this kind of trend continue where the numbers don't look that hot, especially the autos. Wow, they're really getting pummeled. But think of what it would be in real terms, because at the end of the day, we don't want to know what's going on with nominal prices. We want to know with what's going on with economic activity. And therefore, it's a little suspicious that they don't report the real numbers to begin with. Check this out. Advanced estimates of U.S. retail and food services sales for February 2025, adjusted for seasonal variation and holiday and trading day differences, but not price changes. They just say that right here. They adjust for all these things, but not price changes. It's like you would think that if there was one thing that they should be adjusting for, it would be the thing they're not adjusting for. I think that's very curious. But the details, let's zoom in here, for the actual report was so this for February 2025 was a plus 0.2%. Now, the market was expecting a plus 0.6. So way below expectations, especially when you include the revisions, like we were saying earlier, to January of 2025, where the revised number is a negative 1.2%. Getting back to the total dollar amounts. So the trading data, but not price changes, were $722 billion, up 0.2, we said, from the previous month, and up 3.1% from February 2024. So then just do the math. I mean, CPI right now is right around 2.8%, but I think most of you guys on the live stream right now would say real prices in the real economy went up way more than 2.8%, and you'd probably say they went up a hell of a lot more than 3.1. So the main takeaway is, if you're one of those people that do believe the basket of goods went up by more than 3.1%, then you would also, especially the basket of goods that pertain to the metric or the inputs for the metric of retail sales, right? So I'm assuming retail sales don't include housing. I'm guessing they don't include energy, especially when it says retail and food. So yeah, of course it doesn't include energy. So other than energy, housing, okay, you strip that out, and then you got the retail stuff. I think it's extremely important that we, again, want to know. Well, actually, I think the main point here is if you just look at retail and food, and I asked you, what do you think prices of just those categories of the basket of goods, looking just at the CPI in totality, what do you think the prices increased of just retail and food over the last year? I'm sure most of you would say way more than 3.1, which, if that's your base case, or if that's your belief, then you would also have to believe that retail sales, the important metric when you adjust for inflation, would actually be negative. And why is that important? Because the US economy is 70% consumption. And therefore, if you're trying to figure out which direction the economy is going, you've got to look at that inflation adjusted number. That's going to be right up there at the top, in my view, with the unemployment rate and real GDP. By the way, on that, I have not looked at Atlanta Fed's GDP lately. I mean, you guys were, I'm sure, watching my videos on that, how they went from this GDP Now predictor they have, went from, what was it, 2.3 all the way down to a negative 1.5, and then went down to a negative 2.8. So I'm actually curious. I haven't looked at this since I did those videos, but it kind of pertains to the topic at hand here with retail sales. Oh, so it kind of bumped up to a negative. So we were at a negative 2.8, and then it bumped up to a negative 1.5, and now we're back down, most likely because of the retail sales today, to a negative 2.1. Yeah, and the last estimate was March 17th. So I'm assuming they looked at this US Census data, and then they probably looked at the New York Fed manufacturing, which we're going to talk about in a moment, and that's why you got another steep decline. Although I don't know why kind of the number went up here. But getting back to the topic at hand. So I was going to go over this video, but you guys kind of get the gist. They interviewed, CNBC, former Walmart US CEO Bill Simon. He says the consumer might be turning a corner as far as they're tapped out, is the punchline. But look at all these other videos just from today. So Liz Everett from B of A, consumers are changing how they're spending, which she's basically saying the same thing. Target CEO Brian Cornell, of course they got to put on tariffs. Consumers will likely see price increases. Next one, it's unlikely retailers will pass on tariffs, meaning people will spend less money. And a chorus of caution from retailers. And then they talk about another survey where consumer spending declines for the second straight month. And then they're going over the data from the US Census that we just discussed. So, I mean, you combine that with what we were talking about, and I think I deleted the tabs. But last week, if you guys were watching the channel, we talked about American Eagle. We talked about Zara, both coming out and saying that, yeah, sure, we had a decent quarter, but looking out into the rest of 2025, we see the consumer really pulling back. And then you look at the Michigan survey, we talked about that the other day, where it's not just the Democrats now, it's also the Republicans and the independents really expressing concern about the labor market. And that's a big deal, Why is that a big deal? Because we'll just go right over to a tab that I fortunately did not close, which is the unemployment rate. And every single time you get a recession, you get a spike in unemployment. I mean, look, we're going back to 1949 here, and just show me the recession, which is basically indicated by the gray shaded area. Show me the recession where we didn't have a spike in unemployment. That would be zero. That would be zero. So this is as good of an indicator as it gets. And you can see we're starting to trend up. You guys know the SOM rule was triggered from watching my videos. And now, yeah, we're back up to 4.1%. But if the consumer sentiment based on the Michigan survey is correct and the job market is getting weaker, the labor market is softening, then you would expect for this number to continue to go up. Now, are we at the point where it just goes parabolic? Probably not, because that's when the stuff really, really hits the fan. And I don't think we're there yet, but it seems like this cycle could be playing out the same way. No certainties, only probabilities. But my point in bringing up the unemployment rate was just to illustrate how I think this is extremely important to really get focused on in this part of the cycle to see how this plays out. Okay, let's go over to, actually, you know what? I want to look at this article from Zero Hedge, but I'll bet you they did a deeper dive on the retail sales right here. Yeah, let's check this out. Retail sales disappoint in February despite major downward revisions. So here's a tweet, B of A retail sales preview based on real-time card spending data, not pretty. Okay, so they're adding a little bit more nuance here, some more data on top of just the retail sales I went over from the US Census. So this looks like a survey from B of A, which oddly enough came out. Well, let's look at the charts. Okay, so this, if our forecast of flat retail sales ex autos print in February is correct, the 3-month average growth rate would decline. Okay, I guess this is per B of A. And the B of A forecast, Bloomberg consensus, retail sales, and that is for February. So the actual number, if I'm reading this correctly, came in even lower than the B of A forecast. The overall consensus or the overall expectations was 0.6. It looks like Bloomberg consensus was 0.8. So again, a huge miss here, big miss. Well, let's get back to this Zero Hedge article if I possibly can. There we go. Falling last month, 0.9% month-over-month plunge, which was revised down to a negative 1.2%, which we discussed earlier. February saw retail sales disappoint. Okay, we were talking about that. The big contributor, it looks like autos, electronics, gas, department stores, food services. So restaurants, which, look, it's no surprise. I mean, this is discretionary spending, exactly what you would expect. It's Maslow's hierarchy of needs. And when people are really strapped and they start cutting back, you know, they're cutting back on the discretionary stuff here. So biggest drop in food services spending in 2 years. Core retail sales met expectations, but also saw downward revisions. And I think the core is X a lot of things that are really, really important. So that's okay. It's like when they do the CPI or the inflation rate minus everything that you buy every single day. On a non-seasonally adjusted basis, retail sales are actually down year over year, right? And that's even in nominal terms. Oh, here they go. Adjusted roughly for inflation, real retail sales is basically flat year over year. Yeah, and that's if you buy the CPI. And this is this control group that is kind of like cherry picking data just to make things seem better than they are. Trump learning from Biden. January revised much lower means lower. Yeah. That's kind of funny. So now so that's what's happening with the retail, with the consumer. Now let's shift for a moment and go over to the manufacturing survey from the New York Fed. And shoot, I don't have that pulled up, but it should be easy to find here. New York Fed. No, we don't want that. Inflation expectations, manufacturing survey. So Empire State Manufacturing Survey, general business conditions. Let's get the summary. Download full report. Let's see what the media is saying about this. I had this pulled up with Reuters. Let's see if I've Yahoo. I had it pulled up with Yahoo right here. Okay. And they got it from Reuters. So let's just do that. Factory in New York State plummeted this month by the most in nearly 2 years. Survey showed on Monday, with new orders falling sharply and input prices climbing at the fastest rate in more than 2 years, and the latest sign the economy may be weakening. The Federal Reserve Bank of New York said its Empire State Manufacturing Index plunged by nearly 26 points, the largest drop since May of 2023, to a reading of negative 20, down from a positive 5.7 in February. The reading was lower than all 26 forecasts in a Reuters poll of economists, which had a median expectation of minus 1.5. So the median expectation was minus 1.5, and we got a minus 20. That, ladies and gentlemen, is a big miss. And there wasn't even one of the 26 forecasts which was even close to the number we saw. So if you look at the chart, it initially doesn't look that bad because we're here, although I would highlight that this is when the yield curve inverted, roughly. So we have all these negative, and right here at the beginning, we see a big negative right there in January. So maybe this just could be, the weather. It's got to be the weather. It's always the weather. But no, my point is we've seen this play out before, and it didn't really lead to anything major. But the economists that were surveyed, they would have included this in the expectations. And even including this, what we saw last January as an example, the expectation was still for just a negative 1.5, and we got a negative 20. So this in and of itself isn't something that I would worry about, but it's just another thing to add to the equation. And we got to look at the good news, we got to look at the bad news, and we have to determine, okay, based on probabilities, what is the most likely outcome for the rest of 2025. Now let's look at how markets responded. As you would imagine, starting off with my favorite, the bond market here in the 10-year Treasury, down slightly. Actually, it was down more at the beginning of the day, but still inverted because Fed funds is at 4.33, so inverted with the front end of the curve. Let's look at the 2-year Treasury, because I've really been focused on that, because we know that the Fed always, always, always follows the 2-year Treasury. And I don't have that tab, one of the very few tabs I don't have up. 2-year Treasury, we'll just go to CNBC. Oh, it's up quite a bit. Okay. Because it was right around 3.95. And now we're back up to 4.04. So a slight increase, you can see here, this in the last couple days. We'll have to see if this continues to go back up closer to Fed funds, or if it really starts to go back down. I can't find a time when the 2-year Treasury went back, when there was that delta between the 2-year Treasury and the Fed funds, where the 2-year Treasury actually came back up to Fed funds. It's always the Fed funds coming down to the 2-year Treasury, but maybe this time it is different. Dangerous words, but you can't take that possibility off the table. Okay, now let's get back to the rest of the market. So today we had a rebound, Dow up 353 points. S&P basically flat with the NASDAQ. VIX is still higher than what we've seen at 20. Let's go over gold. Aha! Closes above $3,000. $3,010. Like I've said on this channel multiple times, I have no idea what drives the price of gold. I don't think anybody does. I think anyone that thinks gold responds to XYZ, like the inversion of the dollar, or the inflation, or money printing, or M2, or real interest rates, I don't know. I'm very skeptical of that view, because I've gone back and done the research. And although there are times where there's a correlation, there's times where there's an inverse correlation. So to me, it's kind of a coin toss. And if it's a coin toss, I really don't think that's a good indicator. But one common denominator I do see is uncertainty going up, and usually the gold price is going to go up with it. Now, one thing that is weird, because my base case is this cycle plays out similar to past cycles, talk about Fed rate cutting cycles, where we do have a recession or an economic contraction. But look at copper. Copper is calling me out. Copper is saying that I'm wrong. And like I said, we can't just cherry pick the data that fits our hypothesis or our base case. We've got to look at everything. And I mean, copper's ripping. Look at this. So since the inauguration, roughly, since the beginning of the year, copper is almost up $1. It's up 90 cents. Well, copper is saying that the economy ain't that bad, at least the global economy, unless it's something on the demand or on the supply side. There's some sort of supply shock that I don't know about. And on that note, let's look at energy, because that's the ultimate truth serum. And yeah, we've really been in this range for quite some time. It's almost shocking how little volatility we have seen in the price of oil over the last, sure, it came down from 80. But let's go back a year, and it's probably the same price. Yeah, look at this. We just had that spike up to 80, then comes right back down. But we're at 82. At least for the last 7 months, we're pretty much flat. So I don't know what is going on with copper, because all other data points seem to be pointing in economy slowing down direction. Maybe it's saying, global. I think maybe this is stimulus. I'll bet you this is stimulus with Germany and China, where copper is thinking that this government stimulus is going to be a big deal, because it's going to be infrastructure spending, and maybe it's sniffing that out. where the other markets are saying, yeah, stimulus, we've seen this over and over and over and over and over again. We know how this movie ends, and it doesn't end with the economy booming. But even if the economy doesn't boom, maybe, it doesn't matter for copper because they're still spending on the infrastructure. That's just a guess. That's just a guess. And I do know that China came out today with another, I hate to even say the word, but stimulus that isn't stimulus. It's like the sedative. I think that would be a better way to describe. Here, look at this. This is what I'm referring to. China announces plan to vigorously boost consumption. Look, if the central planners and the government can actually boost consumption, what are they waiting for? Like, why didn't you just do this a year ago? Like, if you have that much power that you can just turn this dial like a thermostat on the wall, why didn't you turn that thermostat 6 months ago before doing all of these other things that didn't work? I mean, the key talking points here, I wasn't even going to talk about this, but I think it's important. China announced a special action plan. Oh, a special one. Whoa. Time out. I thought this was just an action plan to boost consumption. I didn't realize it was a special action plan to boost consumption. Well, in that case, okay, look out. I completely changed my view. Forgive me, China. It's just ridiculous. The wide-ranging release also outlines other steps, such as taking multiple measures. Ho! My goodness gracious. Now they're taking the gloves off. So it's a special action plan with multiple measures. Whoo-wee. China is currently facing a sluggish consumer landscape, which again is really weird because the government has come in about 26,000 times in the last year with all of these action plans. But maybe the other action plans weren't special action plans. And maybe the other action plans only had one measure as opposed to multiple measures. But there again, the question becomes, why didn't they do the special action plan with multiple measures right off the bat so they wouldn't have to do anything else? It's a rhetorical question. You guys know the answer. Because the stupid plans don't work. That's why they have to do them over and over and over and over again and expect different results. Just the definition of insanity. And speaking of the definition of insanity, let's go over to Zero Hedge, where they talk about this article from the New York Times, which, look, before I even get there, let me go back to this screen. If you guys need to be sitting down for this one, and you need to be pouring yourself that stiff drink, because this is going to piss you off. This is really, really, really going to piss you off. Getting back to Zero Hedge. See if I can find the article. Here we go. And this is from our good friends, Chris Irons, which will be on the live stream tomorrow, who will be on the live stream tomorrow with Fringe Finance on Substack. And here's his most recent article right here, where he talks about this New York Times piece from this Sunday. This Sunday. Look at this title. And I hope you've poured yourself that stiff drink because you are going to need it. This is going to get your blood boiling. We, including the New York Times, were badly misled about the event that changed our lives. What event do you think that was? You guessed it, the cerveza sickness. I mean, right off the bat, you're like, you've got to, at least I was like, you've got to be kidding me. Like, this takes balls. This takes real balls. This is gaslighting to a level that I don't think I have ever seen before. I mean, can you imagine being the New York Times and actually having the audacity, knowing that you were the one that was pointing the finger during the cerveza sickness and calling for censorship, while you now know that you were the one that was spreading fake news. You were the one that was spreading disinformation and misinformation and malinformation. But yet you were calling for everyone else who, by the way, was telling the truth to get completely deplatformed. I mean, let's not forget this channel, the one you are watching right now, the Rebel Capitalist channel, was taken off of YouTube in the middle of 2021. Why? For saying the truth. For saying the truth. And for calling out the New York Times spreading misinformation and disinformation. And because of that, the YouTube channel is taken down. Now, you guys know the backstory. Thanks to Joe Rogan and him retweeting it, and YouTube put the YouTube channel back up very, very quickly. But if it wasn't for Rogan getting involved, I don't know. The Rebel Capitalist channel, maybe something that we may not be here today. But getting back to the New York Times here, this ultimate gaslighting. So Chris rightfully points out a meme that I think was going around Twitter, which is what the title should have been. So the title should not have been we were badly misled about the event that changed our lives. But the title should have been we badly misled you about the event that changed our lives. And the thing that really pisses me off is they just try to slough the blame on other people instead of just being a man about it, just having the integrity and the character to say, you know what, we screwed up. You know what, all those people like Chris Martenson, like Joe Rogan, like Dr. Malone, and all these other people that I'm sure I'm forgetting, instead they don't apologize to those people for attacking them and demanding that they get deplatformed and trying to tell all their readers to just ignore those people on YouTube and alternative media because they're just sitting there eating horse paste like a bunch of retards that ate too much glue and paint chips when they were a kid. I mean, that's the way they were portraying the people in the alternative media space who turned out to be correct, who turned out to be on the right side of history. But do you think they're apologizing? Absolutely not. They were saying that it's like those people prior to the GFC that nobody saw this coming. Like nobody could have predicted this just because we didn't predict this. When in reality, there were a lot of people like Schiff that were talking about it, or a few people, and they don't give them credit. And the same thing here, instead of saying, well, we should give credit to the people that were right and the people that we were condemning and the people that we were throwing stones at and the people that we were accusing of misinformation and disinformation, those people were right. Instead of just saying that and saying, you know what, we're going to do our best to next time improve. But no, they can't say that. They have to say that, we were all badly misled. Sure enough, all those things that we were saying were conspiracy theories, I guess they turned out to be conspiracy facts. But can't blame us. It's because we were misled. And obviously nobody out there could have known the truth. And I was just talking to Barnes about this. If you guys are fans of the channel, have been watching for quite some time, one of the things I was really harping on, or one of the stories I was really harping on in the middle of 2021, when my channel got taken down for speaking truth, and my channel got taken down for, of course, misinformation and disinformation. But one of the things I was really harping on back then was that Forbes article that came out that was saying that it is literally dangerous for you to do your own research. Remember that? Right in line with what the New York Times was saying. And as fate would have it, it turns out those people that did their own research, it actually wasn't dangerous, was it? because they were on the right side of history. What was actually dangerous was to listen to Forbes. What was dangerous was to listen to the New York Times. And by the way, think how much blood they have in their hands for pushing the medicine, which we know when you age stratify it, the cost benefits really don't make that much sense. And I'm putting it mildly. But of course, they're never going to take the blame for that. And Chris writes a fantastic article pointing out that it wasn't just the cerveza sickness where the mainstream media was gaslighting you. It was also Joe Biden's sharp as a tack. Remember that one? I mean, geez. The Russian disinformation, laptop. And then, of course, with the cerveza sickness, it was everything about the cerveza sickness. But one of the main things there was, of course, the lab leak theory, which was just shot down by the New York Times. Oh, it's a conspiracy. It's just Alex Jones. Oh, we get him off of Twitter. Blah, 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 blah. And then sure enough, oh, well, maybe, there might be something to that. And here's what you get, and rightfully so. And it's not just the opinion, and Chris points out the opinion of the Democratic Party right now, which is basically at all-time lows. You see the favorable rating, 29%, the unfavorable, 54%. And I talked to Barnes about this today as well. But it's the mainstream media. I mean, if you looked at an opinion poll of the mainstream media, it would be lower than the Democratic Party. And I assure you it would be at all-time lows. And that's with Democrats and Republicans. So they should be looking at themselves in the mirror, my friend. And then he talks about how Gavin Newsom started his own podcast to just interview a bunch of people and interview Republicans and people that were right. And remember Newsom. Was it Newsom or was it another politician in California? They were sitting there just ripping on people for not wearing their mask. And then it shows them at like a baseball game, no mask, nothing, just partying down, having cocktails, shaking hands. I mean, come on. Just the used car salesman that he is. Michelle Obama started a podcast that Chris points out that absolutely tanked. And it's no surprise. And then he points out how CNN, a lot of the anchors have been fired, or a lot of the quote unquote journalists, reporters, MSNBC, a lot of the people are quitting or they're taking time off for whatever. It's just, I mean, at the end of the day, it's a good thing, because this is really starting to shine light on this entire ruse that is the mainstream media, just a propaganda wing of the global elite. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism. We'll see you in the next video.